Hi, everyone. My name is Emily Black, and I'm presenting Algorithmic Fairness and Vertical Equity, Income Fairness and Tax Audits, which is joint work with Hadi Elzayn, who is also first author, Alexandra Chouldechova, Jacob Goldin, and Daniel Ho. In this project, through a novel collaboration with the United States Internal Revenue Service, we investigate the impact of using machine learning systems in the IRS audit context as it looks to modernize its audit selection system. We investigate what steps can be taken to prevent inequity from AI systems in the audit context. We focus on investigating the fairness of audit allocations with respect to taxpayer income. To do so, we borrow from the public finance literature to introduce a new fairness framework called vertical equity. Vertical equity has to do with treating different people appropriately differently, as opposed to horizontal equity, which concerns treating similar people similarly, arguably the focus of most common fairness definitions currently in the literature. We find that many off-the-shelf fairness interventions can be ill-suited for the IRS audit context, both due to imperfect fit of their implementations with a budgeted allocation problem, and also with a mismatch with the contextualized fairness desiderata, such as vertical equity. This ill fit of common bias mitigation techniques may be relevant to a wider set of policy contexts, pointing to a need for better tuned fairness metrics and bias mitigation techniques for many policy problems. I'll start with a bit of background on the IRS. Taxes fund our government, but tax collection doesn't always work perfectly. The estimated yearly tax gap, or difference between amount owed and amount paid, is about $450 billion, or about 20% of all income tax liability. In order to recover lost revenue and deter noncompliance, the IRS audits individuals by investigating tax returns, which suggest noncompliance with the tax code. How audits proceed often depends on whether an individual is on the higher or lower end of the income spectrum. Higher income individuals may receive a request for excess tax liability after an investigation, whereas lower income individuals are often audited about potentially falsely claimed credits and have audits done through correspondence, where a tax refund is denied prior to the investigation. Audits can pose a heavy burden on everyone, as they can be stressful, time-consuming, and even can lead to financial hardship. According to the National Taxpayer Advocate's National Report to Congress, this is particularly true for low-income individuals. Given the high-stakes nature of IRS audits, it's important that we find an audit allocation system which distributes audit equitably with respect to taxpayer income. This is the focus of this project. With all this in mind, we endeavor to begin to answer the following question. How can we make a machine learning-based audit selection system as fair as possible with respect to an individual's income? In this work, we present the following contributions. We introduce vertical equity to algorithmic fairness. We show that high complexity models can exacerbate vertical inequity. We demonstrate that classical fairness promoting interventions are often not well suited for budgeted policy problems, especially in the IRS context. We show that changing a model's prediction target instead can improve fairness while avoiding a steep performance fairness trade-off. And finally, we demonstrate that agency constraints and policy choices may have a strong influence on audit allocation equity. In this work, we explore real IRS tax data. We use two data sets. First, the NRP data, or National Research Program data, which consists of line-by-line audits of a stratified random sample of the US population from 2010 to 2014. Second, we have operational audits from 2014, which are risk-selected audits to identify tax evasion. Each observation contains information filed in a tax return, and all dollar amounts are adjusted for inflation of 2014 dollars. We train all models on NRP data since it's a stratified random sample, but we start, however, with investigating the status quo audit behavior on operational data from 2014. We'll begin our investigation by presenting some motivating facts about the status quo of income tax audits. Here we have the graph of IRS audit rate by income in 2014. The y-axis is the audit rate, in other words, percentage of the population audited. And the x-axis is income in thousands. Each point represents the audit rate of a bucket of individuals whose income span $10,000. So 0 to 10,000, 10,000 to 20,000, etc. We highlight two motivating facts. First, in recent years, the lowest income earners have been audited at the same rate as the highest income earners. This red line indicates that individuals making less than $50,000 have the same audit rate as individuals making between $700,000 and almost $1 million in income. And everyone in between these two numbers is audited at a lower rate. When we replot this graph over income deciles, in other words, groups of 10 percentiles of the US population, where the x-axis is now income in thousands for the lower bound of each 10 percentile bucket, and each point is the audit rate of a decile of the population, we see that the lower to middle income deciles are audited at the highest rate, and the spike from the first plot actually makes up about 30% of the US population. However, consider this graph of tax misreporting, in other words, non-compliance by income decile. Again, the x-axis is income in thousands for the lower bound of each decile, and the y-axis is the rate of non-compliance over 200, this blue line, $200. We see that non-compliance increases roughly monotonically in income. This leads to a motivating question that will influence our understanding of equity in this context. If misreporting increases monotonically with income, why does the audit rate focus so heavily on lower to middle income classes? We quickly formally define the audit problem before moving on to our understanding of equity in the income fairness context and our main results. The simplified audit problem is to choose audits to maximize revenue subject to a budget, where we view the audit budget as a percentage of the population, in this case, 0.644% based on the average audit rate from 2010 to 2014. In practice, we approximate the audit allocation problem with maximizing the sum of output from a machine learning model. So the expected tax liability for regression models or the predicted probability of misreport for classification models. Thus, after prediction, this amounts to selecting individuals for audit in order of greatest prediction. We note in practice that the IRS auditing problem is much more complex than simply maximizing revenue, but also has to balance other goals such as deterrence. Our goal in this project is to create an allocation which is as equitable as possible without greatly decreasing revenue or increasing the rate at which the IRS audits individuals who do not actually owe extra tax, which is called the no change rate. With this simplified audit problem and relevant background in mind, we discuss what equity with respect to income means in the IRS audit context. So what are the fairness desiderata in the IRS context? To understand this question, we borrow a notion from the public finance literature, vertical equity. Vertical equity is centered around the idea that individuals or groups with relevant differences between them should be treated appropriately differently. Arguably, algorithmic fairness is often centered around the idea that equity means that people are equal in all respects and thus should be treated similarly. This leads to equalizing rates of some sort or another across demographic groups. In tax policy, this concept is called horizontal equity. Contrastingly, vertical equity acknowledges the differences between people, like differences in income and wealth, and posits that people must be treated differently because of their differences in order to achieve fairness overall, like our progressive tax code, which taxes higher income individuals at higher rates. Vertical equity is not a fairness definition, but rather a framework or vantage point from which to think about fairness desiderata. It requires information and assumptions about a given context in order to be meaningful, like what are appropriate differences and how should we appropriately account for them. We offer one interpretation of vertical equity in this context. First, given that audits may pose varying burdens on individuals with different incomes, and in particular, lower income individuals may suffer a greater burden from a tax audit, we give preference to audit allocations which decrease audit focus on lower income individuals. Formally, we prefer audits that have an audit rate which are monotonic in income. Additionally, we prefer allocations that are close to that of an oracle under the same budget, where an oracle is a model with perfect knowledge of every taxpayer's true misreport and selects an order of magnitude of excess tax owed. This is not just an accuracy requirement. Since the audit problem involves selecting up to a budget, this means that the model should also rank similarly to an oracle. We measure this by calculating the oracle overlap, or the ratio of the size of the intersection of the oracle and a given model's audit allocation at a certain budget over the total size of the allocation. To recap, we want to increase vertical equity, so we prefer more monotonic allocations with a higher oracle overlap, but we also want high revenue and a low no change rate, in other words, the rate of auditing individuals who do not actually owe excess tax. We now turn to our results. We turn first to the impact of higher complexity classification models on audit allocations. We find that more complex classification models do increase accuracy and thus decrease the no change rate, the percentage of audits on people who do not owe extra money, to 3% from about 13%. Given that the probability of misreport increases with income, it may seem natural that higher complexity models would shift audit focus to high income individuals. However, we find that high complexity classifiers actually exacerbate audit focus on lower income groups. We see the difference between audit allocations of high and low complexity models in the following graphs. Here we have the audit rate by income of the allocation of a simple LDA classifier. On the y-axis, we have audit rate, and on the x-axis, we have the income in thousands per income decile, where the income is the lower end of the decile. The black line shows the audit rate by income of the LDA allocation, and the red line shows the audit rate by income of the oracle allocation. Remember, this allocation is only the top 0.644% of taxpayer population, not all positive predictions as per our budget. When we switch to a random forest classifier here on the right, we see that while accuracy does improve as reflected in the low no change rate, The more complex random forest classifier actually exacerbates focus on the lower to middle income portion of the population and also does not audit the highest income groups at all. Thus, we see that here, higher model complexity can lead to higher vertical inequity. To fix this problem, we first tried to use some of the many common bias mitigation techniques to decrease audit focus on low income groups. While we present other definitions in the paper, here we only focus on equalized odds, on enforcing equalized odds, which is defined as the requirement that compliant or non-compliant taxpayers' probability of being audited should not depend on their income. We implement enforcing equalized odds on random forest classifiers using FairLearn's implementations of Agrawal's et al.'s reductions approach to fair classification. We found that these techniques were first ill-suited for the IRS context and potentially a greater group of policy problems due to the incompatibility with a budgeted allocation. Secondly, we found that this technique led to minimal vertical equity gains due to potentially not optimizing directly for vertical equity. And finally, we found that even these marginal equity gains incurred significant deterioration in no change rate and revenue. As an example, consider this graph of the audit rate by income decile of an equalized odds constrained classifier, equalized odds constrained random forest classifier in blue. The x-axis is income in thousand for each income decile, and the y-axis is audit rate. The black line is the original random forest audit rate of the original random forest classifier's audit rate by income of their allocation, so the top 0.644%. The red line is the Oracle's audit rate by income of their allocation, and the blue is an equalized odds constrained random forest classifier. In other words, the model was trained to have all income deciles have the same true positive and false positive rate. Although this isn't directly obvious from the graph, I'll first note that the budgeted nature of the IRS audit problem prevents these off-the-shelf methods from performing as builds. While equalized odds is satisfied over all positive predictions, it is not satisfied over the allocation of 0.644% of the population. Secondly, there's only a marginal equity improvement here. The audit rate is higher on the lower to middle income classes than the highest income classes, and the Oracle overlap is only about 4% of the allocation. This is likely partially due to the complication with the budget, but also points to the fact that enforcing equalized odds does not exactly overlap with our vertical equity goals, showing a mismatch between mitigation techniques and contextualized fairness desiderata. Finally, we see that all these marginal equity gains from enforcing a fairness constraint during training actually leads to very high trade-offs in this setting. A revenue loss of $2.52 billion from $3 billion originally, and increasing the no change rate by 10%. However, we find that there is another way that we can increase vertical equity in this setting. We find that it's possible to improve vertical equity by changing the loan selection model's prediction target from classification to regression. That is, we predict the expected amount of misreport per individual instead of the probability of them misreporting. Additionally, this leads to a $7.17 billion increase in revenue. And while it also does lead to an increase in the no change rate of about 19%, since other methods decreased revenue and increased no change rate, this does decrease the overall trade-off. In the black line in this graph, we see the audit rate by income decile of a random forest regression model, which predicts the expected amount of misreporting. The red line is the Oracle allocation. We see a larger vertical equity improvement than the off-the-shelf methods, increasing Oracle overlap to 23%, and we can see that the allocation, while not perfectly monotonic, closely reflects the monotonicity of the Oracle. And we have lower trade-offs. While there is a large increase in no change rate, we increase revenue by 7.17 billion, reaching total revenue of over 10 billion as opposed to 3 in the classification model. We can see here then that pipeline-based interventions are effective at increasing fairness in machine learning systems. We close with investigating how agency constraints affect audit allocation equity. Due to budget realities and policy decisions, targeting higher income taxpayers can be much more costly to the IRS than low income taxpayers, while auditing low income individuals is cheap and likely to return revenue. When considering the IRS budget as a dollar amount in a strictly return on investment based approach, targeting low income taxpayers is the most effective way to maximize revenue, especially in low budget regimes. We can see this in this graph, which shows the audit allocation selected with an optimal return on investment approach for all machine learning models considered in our paper. And we here think of budget as a dollar amount. We have audit rate again on the y-axis and income decile on the x-axis. We see that this return on investment approach leads to all allocation focusing almost exclusively on the lower to middle income class. We'll end with some takeaways from this paper. To summarize, this work shows us that modeling changes, even those that are not on their face fairness related, can successfully increase fairness in real world settings. Secondly, we show that off-the-shelf fairness mitigations may not work well in budgeted policy problems. And finally, we show that agency constraints and policy choices can influence the equity of allocations in the IRS context and potentially other government contexts as well. Please read our paper for more detail on all of these points and further experiments with off-the-shelf classification methods. Thank you so much.